The Mexican peso has just executed the most aggressive financial maneuver in North American history. 18.00 against the dollar is no longer a support line, it is a kill zone for export margins. The data from October 2025 is not a correction, it is a massacre for the automotive sector. We are witnessing a 14% collapse in auto export value in a single month, while the currency strengthens. This is not standard market volatility. This is an industrial heart attack triggered by a currency too strong for its own good. Agave farmers, maquiladora owners, and auto parts giants are watching their profits evaporate in real time. The super peso is no longer a trophy of stability. It is a tactical nuke detonating inside the export economy. If you hold dollars, if you export goods, or if you rely on remittances, you are currently in the blast radius. The Federal Reserve has cut rates, but Banxico is holding the line, creating a pressure cooker that is crushing profitability. We are tracking a 19.5% drop in agricultural revenues. Avocados and tomatoes are rotting on the balance sheets. This is the story of how a currency became a weapon against its own creators. Subscribe now and check your portfolio. The rules of engagement for the North American economy have just changed. The financial radar screens across Mexico City, Monterrey, and New York are currently lit up with a singular, blinding anomaly. For decades, the narrative of the Latin American economy was one of depreciation, inflation, and the desperate scramble for hard currency. That narrative has been shredded. We are observing a phenomenon that defies the traditional gravity of emerging markets, the resurgence of the super peso in late 2025. This is not a gentle appreciation. It is a relentless, hydraulic squeeze on the machinery of international trade. The exchange rate, hovering aggressively around the 18.00 mark, represents a tactical victory for the central bank's inflation fighters, but for the industrial base that powers the nation, it is a logistical nightmare. The currency has become a fortress impenetrable, imposing, and for those trying to sell goods abroad, utterly suffocating. To understand the magnitude of this event, we must first inspect the arsenal that built this fortress. The primary weapon system is the interest rate differential, the spread. As of December 2025, the Federal Reserve in the United States has retreated, cutting rates down to the 3.50% range in a bid to cool the American labor market without freezing it. In stark contrast, the Bank of Mexico, Banxico, has maintained a much higher defensive posture, with rates hovering north of 7.00%. In the brutal calculus of global finance, this 350 basis point gap is a magnet. It attracts billions of dollars in carry trade, speculative capital that borrows cheap dollars to buy yielding pesos. This capital inflow acts like armor plating for the currency, deflecting any attempt by the market to weaken it. But this armor is heavy, and it is crushing the soldiers on the ground. The exporters. We must also factor in the heavy artillery of foreign direct investment, FDI. The near-shearing wave, often discussed in abstract terms, is now a tangible, concrete reality on the ground. Throughout 2024 and 2025, over $37 billion flowed into Mexico, funding new plants for Tesla, BMW, and electronics giants moving away from Asia. Every single dollar of that investment had to be converted into pesos to pay for cement, steel, and labor. This demand created a structural floor for the currency. The peso didn't just get lucky. It was engineered to be strong by a massive influx of industrial capital. However, this engineering failed to account for the speed of the ascent. The currency appreciated faster than the factories could improve their efficiency, leaving them exposed to a brutal reality. Their costs are in expensive pesos, but their sales are in cheap dollars. The final component of this scenario is the remittance corridor. For years, the flow of dollars from workers in the U.S. to families in Mexico was a safety net. Now, that net is fraying. With a super peso, the $300 sent home buys significantly fewer tortillas, less gas, and less construction material than it did 2 years ago. The purchasing power of millions of families is being eroded not by inflation, but by the strength of their own money. It is a paradox that is cooling domestic consumption in rural areas just as the export sector begins to stall. The arsenal is impressive: high rates, massive FDI, strong remittances, but it is currently aimed squarely at the foot of the Mexican economy. The stage is set for a confrontation between financial stability and industrial survival. Intelligence reports from the border regions, the industrial spine of the continent, indicate that the damage is no longer theoretical, it is statistical and severe. The detection systems within the Mexican Institute of Statistics and Geography, INEGI, flashed red in October 2025. The data revealed a shock that many analysts had whispered about, but few expected to see so clearly: a 14% year-over-year decline in the value of automotive exports. This number is catastrophic. The automotive sector is not just a part of the economy, it is the engine. When this engine misfires, the vibration is felt from the assembly lines in Puebla to the boardrooms in Detroit. This drop didn't happen because Americans stopped buying cars. It happened because the translation of those sales back into pesos is resulting in a financial hemorrhage. Further reconnaissance into the agricultural sector reveals an even grimmer picture. The green gold avocados, along with tomatoes and berries, has long been a crown jewel of Mexican exports. But the intelligence briefing for late 2025 shows a 19.5% plunge in agricultural export revenues. Farmers are shipping the same volume of product, laboring under the same sun, and paying the same high costs for fertilizer and diesel, but the return on investment has collapsed. The detection of this trend was delayed because volume remained high, but the value capture has been decimated. The super peso acts like a tariff that Mexico has imposed on itself, making its goods 15% to 20% more expensive or less profitable than they were during the currency's weaker phases. The radar also picks up a significant cooling in the maquiladora zones of Tijuana, Juarez, and Reynosa. These factories operate on razor-thin margins, often pennies on the unit. Their business model depends on arbitrage, earning in strong dollars and paying in weak pesos. That arbitrage has inverted. Intelligence from the ground suggests that bidding on new contracts is stalling. Factory managers are reporting that they are losing bids to competitors in Vietnam or India, not because of quality or proximity, but because the Mexican cost base has exploded in dollar terms. The nearshoring advantage, being close to the US, is being eroded by the pricing disadvantage. The detection systems are screaming a warning. The country is becoming too expensive to be the world's workshop. We are also detecting a shift in the carry trade dynamics. While the spread is still attractive, the volatility is rising. Speculators are starting to hedge their bets. The intelligence community in the forex markets is noticing an increase in options trading that bets on a sudden depreciation. This suggests that the smart money knows this situation is unsustainable. They are preparing for a snapback, a moment where the tension in the currency creates a violent correction. But until that happens, the export sector is trapped in the crossfire. The indicators plummeting export values, shrinking margins, and hesitant contract renewals are all pointing to a deepening crisis of profitability. The clock ticks past 8 a.m. in Mexico City, and the trading desks are fully manned. The atmosphere is tense. The screen shows the USD-MXN pair fighting to break above 18.05, but every time it lifts its head, a wave of selling smashes it back down. The super peso is relentless. On the factory floor of a Tier 1 auto supplier in Guanajuato, the reality of these numbers is physical. The plant manager is looking at a spreadsheet that bleeds red. He has to pay his 500 workers their weekly wages today. 2 years ago he needed $50,000 to cover payroll. Today, to buy the same amount of pesos, he needs nearly $65,000. His revenue from Ford or GM hasn't gone up by 30%, but his labor cost effectively has. He is watching his profit margin dissolve into the currency exchange. It is 11:30 a.m., and the pressure intensifies. Reports are coming in from the agave fields of Jalisco. The harvest is in full swing, but the mood is somber. A cooperative of tequila producers is meeting to discuss the export crisis. They are selling bottles to distributors in California for $40 a case. In 2023, that $40 meant nearly 800 pesos. Now, it barely scrapes 720. Meanwhile, the cost of the glass bottles, the cardboard, and the transportation, all priced domestically, has risen with inflation. They are being squeezed from both ends. The confrontation is visceral. It is a battle between the macroeconomic stability promised by the central bank and the microeconomic survival of the producer. The producers are losing. By 2 p.m., the markets digest the latest Federal Reserve minutes. The U.S. signals it might cut rates again in early 2026. The algorithm bots react instantly. They sell the dollar and buy the peso. The chart on the screen dips, 17.98, 17.95, 17.92. The super peso strengthens further. In the corporate HQs of the mining giants, this tick down is a disaster. Mexican mining exports are down 24% year-to-date in value. Every cent the peso gains is millions of dollars in lost revenue for copper and silver exporters. The CFOs are on the phone with their hedging desks, screaming for protection, but the cost of insurance is skyrocketing. The confrontation is no longer just about trade, it's about solvency. Companies that borrowed in pesos but earn in dollars are facing a debt service crisis that no one planned for. As the sun sets over the industrial parks of Monterrey, the shift change whistle blows. But there are fewer workers walking out the gates than there were 6 months ago. The silent casualty of this currency war is the hiring freeze. Confronted with the super peso, companies are choosing not to expand. The help wanted signs are coming down. The confronting reality is that while the currency is strong, the industrial momentum is weakening. The machinery is slowing down, grinding gears against the friction of an overvalued exchange rate. The night shift begins, but the hum of the factory feels less vibrant, dampened by the heavy blanket of financial pressure. The battle for the day is over, but the war for margins continues into the night. The smoke clears on the fiscal battlefield, and the casualty count is undeniable. The super peso phenomenon of 2025 has delivered a harsh lesson in economic physics. What goes up must eventually drag something down. The export sector, the very engine that was supposed to drive Mexico into developed nation status via nearshoring, has taken a direct hit. The 14% drop in auto revenues and the near 20% slash in agricultural income are not just statistics, they are scar tissue on the economy. The message from the market is loud and clear: currency strength without productivity growth is a trap. Mexico has proven it can have a stable currency, but it is now learning the painful cost of that stability when it decouples from the real economy. The balance of this operation reveals a divided nation. On one side, the consumer and the importer are victorious. Walmart de Mexico and Amazon are flooded with cheaper imported electronics and clothes. The inflation rate has been tamed, partly because imported fuel and grain are cheaper. This is the positive side of the ledger. But on the other side, the producer, the entity that actually creates value and jobs, is bleeding. The strategic error was assuming that a strong peso was purely a sign of health. It is now clear that it can also be a symptom of a restrictive monetary tourniquet that cuts off blood flow to the extremities of the export body. Looking forward to 2026, the tactical directive for Mexican industry is adaptation or atrophy. The days of relying on a cheap currency to remain competitive are gone and buried. The only way to survive a 17.00 or 18.00 peso world is to radically increase efficiency. Automation, better logistics, and higher value-added products are no longer optional upgrades. They are survival requirements. The government and the central bank face a critical decision point: continue to defend the peso to crush inflation, or loosen the grip to allow the export engine to breathe. The current path is unsustainable. You cannot have a super currency and a super export sector simultaneously without massive productivity gains that haven't happened yet. This is the final warning for investors and business owners operating in this theater. The volatility is not over. The super peso trend has exposed the fragility of margins across the board. If the U.S. economy enters a recession in 2026, or if the political winds in Washington shift towards tariffs again, the peso could snap back violently. But until then, the pressure remains maximum. Do not confuse a strong currency with a strong economy. They are not synonyms. Secure your positions, hedge your exposure, and keep your eyes on the export data. That is where the real story is being written, in red, ink, and sweat. Dismissed.